For corporations, the foreign tax credit is your tool to avoid double taxation when income is taxed by a foreign country and the US. It's claimed on Form 1118 and attached to the corporate return. On the EA exam, they'll test whether the levy is the right kind of tax and whether you're using the right form. Individuals use Form 1116. Corporations use 1118. Not every foreign charge is creditable. The foreign tax credit is for foreign income taxes, or taxes in lieu of an income tax. A classic trap is VAT or sales tax. Those are real taxes, but they're not creditable for the FTC. Think, income tax? Yes. Transaction tax? No. If it's not creditable, you might still get a deduction, but not the credit. 2 more exam favorites. First, the credit is non-refundable, so it can't create a refund by itself. Second, you can't claim a credit for a tax you don't legally owe. If the foreign country will refund it, or you never owed it under their law, it's not a creditable tax for US purposes. That's the IRS saying, no credit for optional foreign tax payments. Even when the tax is creditable, you may not get to use all of it this year. The foreign tax credit is limited, so you can't use foreign taxes to wipe out US tax on US source income. On the exam, you don't usually compute the full limitation, but you do need the concept. The FTC is capped, and excess becomes a carryover, not a refund. When you have excess foreign taxes over the limitation, corporations get carryovers with a strict ordering rule. You carry it back 1 year first, and only to offset US tax in the same category. Then, any remaining excess carries forward 10 years, again, limited to the same category. On the EA exam, they love the timeline: 1 year carryback, 10-year carryforward. Last point, credit versus deduction. A corporation can choose to deduct foreign taxes instead of taking the credit. A credit reduces tax dollar for dollar, so it's usually better than a deduction. But if the credit is limited and you can't use it, a deduction may still provide some benefit now. Just remember, you don't get both for the same foreign taxes. Marcus owns a barbershop with 10 employees. In 2023, his gross revenues are $900,000. He spends $24,000 modifying the shop to provide restroom access to customers with disabilities. What is the amount of Marcus's disabled access credit? The options range from $0 to $5,000 to the full $24,000 or $12,000. Think about it. The answer is $5,000. The disabled access credit is generally 50% of eligible costs over $250, but only up to $10,250 of spending. That creates a maximum credit of $5,000. $12,000 is tempting because it's half of $24,000, but the credit is capped. Ethan is a professional securities broker-dealer. His business is an S corporation, and he's the sole shareholder. He files single. In 2023, his taxable income before any QBI deduction is $268,000. Is he eligible for the $199, a 20% QBI deduction? The choices include not enough information, no, partial, or yes. Think about it. The answer is no, he is not eligible. Brokerage services are a specified service trade or business, an SSTB, with taxable income of $268,000 as a single filer in 2023. He's above the full phase-out range, so the QBI deduction is fully disallowed. Partial deduction is the trap if you forget the phase-out is already complete.